My name is Jake, welcome to the channel. In today's video, I want to talk about an ultra high covered call ETF in NUSI. NUSI is an ultra high dividend ETF that pays a monthly dividend and one that I'm considering making the largest position in my portfolio. Yes, you heard me correct. I'm looking to invest in a NUSI and make it one of my largest positions in my portfolio. I haven't done it yet today, but I've done a lot of research and I'm really excited to share with all of you the research that I've done and what I've considered when it comes to investing in a NUSI. And so if you're a new investor and you've heard about covered call ETFs or income producing monthly dividend ETFs, this is one of those videos that you're really going to want to watch. I'm going to go into detail and share everything that you need to know if you're considering starting a position in NUSI. NUSI is not the only covered call ETF out there. In fact, a month ago, I shared an entire video on QYLD and JEPI. And so if you're not familiar with what a covered call ETF is, I'd recommend going and checking out this video. In this video, I'm not going to go into detail about what a covered call ETF is. And so if you're not familiar, I would recommend you watch this video right here. For those of you that have been following the channel, you know that my wife and I are looking to retire in the next 5 years. We're in our mid-30s right now. We currently invest into a dividend growth portfolio here in M1 Finance. I currently have 40 holdings in this portfolio. The average weighted dividend yield of this portfolio is just around 3%. So investments like Johnson & Johnson, Pfizer, AbbVie, 3M, PepsiCo, Waste Management, McDonald's, Altria Group, UPS, etc., all of these companies combined, the weighted average is about 3%. And so if you do the math, 3% is not very high. The growth rate, this portfolio is growing substantially faster than the ETF that we're going to talk about today. And there's a lot more upside potential, but there's also a little bit of downside potential as well. So there's some pros and cons. But what I'm getting at with this portfolio is going to take my wife and I much longer to amass the portfolio size that we need to live off of the dividend income to pay for our living expenses. And that is why I'm so excited about NUSI, because NUSI has a much higher starting dividend yield. In today's video, we're going to cover 4 topics. First, I'm going to cover what is a protective caller option strategy. That is the strategy that is used by NUSI. If you're not familiar with that, don't worry. I'm going to break it down in very simple terms. Second, we're going to review NUSI. We're going to dive really deep into the fund methodology, the performance of the fund, the fees, the performance in a bear, bull, and flat market, and then the tax implications. And then what we're going to do is we're going to compare NUSI to other income generating strategies. And then third, we're going to talk about who should and should not invest in a NUSI. And then lastly, I'm going to share my thoughts on NUSI and why I'm considering making NUSI one of my largest positions in my portfolio. I'm so excited for today's video. A lot of you have been commenting on my videos asking to do a review of NUSI. So I'm really excited to go into detail and talk specifically about this ETF. And when I found out that NUSI has an average dividend yield of 8%, it really got me feeling like this. Oh my gosh, I think it's pretty fitting considering that Richard Branson just flew into space today. It's a really exciting time to be alive. So a protective caller option strategy, it combines the use of covered calls. We learned about covered calls in that other video. So if you haven't watched that video, I'd highly recommend you watch that so you understand covered calls. And a protective put option with the objective of generating income while protecting investors from downward market losses. So what this means is your potential, your upside potential is limited, but your downside potential is also limited. So, and because the fund managers of this ETF are writing calls and doing this on a monthly basis, you're getting that monthly income in the form of the premium, right? Or the distribution, if you will. And so you're capped at what you can make on the upside, but also capped at what you can lose on the downside. That is a protective caller option strategy. Not a lot of covered call ETFs implement this strategy, but I personally love it. And we'll talk about this later towards the end of the video because it creates sustainability and predictability as an investor. So how does this actually work with NUSI? So NUSI tracks the NASDAQ 100. So what it does is it actually purchases the companies in the NASDAQ 100 instead of just owning it through an ETF. So when you purchase NUSI, you actually own companies in the NASDAQ. So that's very, very important. You're actually owning these companies. And then second, what it does is it deploys rule-based the option caller strategy that we just talked about, writing calls, put options on a monthly basis. And then what it does is it pays you as a shareholder monthly distributions from the premiums. And then lastly here, they have the option to have the additional premium be used to reinvest into the underlying portfolio of the NASDAQ 100 stocks. When it comes to a fund methodology perspective from NUSI, there's really three things that they're focused on. They're focused on targeting high monthly income in the form of a distribution based off of a rule-based option strategy, while also focusing on downward protection and risk mitigation. That's in a nutshell how NUSI operates. One thing to be very mindful of is NUSI is not cheap. NUSI has a very high expense ratio. It's very high in my opinion, compared to the other investments that I have, other index funds that I hold in my portfolio. A 0.68 would be by far the highest expense ratio of any investment that I hold in my portfolio. The expense ratio is on the higher end, and it is important that you understand that. Whenever I look at an investment, I always try to benchmark it against the S&P 500. And when I'm benchmarking my investment to the S&P 500, I am looking at the total returns, or the NAV, the net asset value. And so this is really the total return with the dividend reinvested. If you just go to Google or Yahoo Finance and look at the ticker and you just look at the share price, you're only getting half of it. You need to really, if you're comparing an investment with another investment, you have to look at the total return. Because NUSI has only been around since the end of 2019, we don't really have a lot of historical data. And we know in 2019, 20, and 21, we've had a little bit of everything. We've had market volatility. We've had a very frothy, stock market, a very crazy, irrational market, and it's really been a Fed's market. And so I try to take this with a grain of salt when I'm comparing and looking at historical data. I take all of this with a grain of salt. I really like looking at the historical returns, not as an indicator of where it's going to go and how it's going to perform in the future, but really trying to understand, because I believe the past has a story to tell. And if we understand our history, we can then make better investment decisions going forward, because we all know that historical performance is no guarantee of future performance. The most important thing that I'm seeing here on this chart is the blue line represents the total return of the S&P 500, and the orange line represents the total return of NUSI. And what you'll notice is right here at the peak of the pandemic fear here in March, you see that the S&P 500 was the deviation, the beta is much, much higher, that the price volatility is dramatically higher than in NUSI. So if you're investing in the S&P 500, you saw your portfolio go down about 30%. Whereas if you were investing in NUSI, you saw your portfolio value down about 5% in terms of the total return. So the volatility, this is the key thing. What gets me so excited about NUSI is you don't see those massive swings to the upside and to the downside. And what I mean by the upside, you see here in 2021 where the S&P 500 has just gone up dramatically, right? How you've seen the market go up, whereas NUSI is kind of capped at its upside potential. Remember how we talked about with that caller strategy, where the gains are capped based off of the strategy that they're running, but also the losses are capped due to their put option strategy. And as someone looking to retire off of his dividend portfolio or live off the dividends from his investments, this is something that really, really gets me excited, because I personally, when I'm in retirement or when I'm financially independent, volatility is not necessarily something that I'm going to get excited about. While I'm growing my wealth, I get very excited about volatility because I can take advantage of it. But in early retirement, volatility is not something that I really want to have in my portfolio. And so this is something that I really, really like seeing as a conservative dividend growth investor. Now, it's very, very important to understand how NUSI is going to perform in different market conditions. If you have a bear market, if you have a bull market or if you have a flat market, because the returns are going to be different in every single market. In a rising market, in a bull market that we're seeing right now, the upward potential is going to be limited, as we mentioned. So the most of the appreciation that you're going to see with NUSI in a bull market is really in terms of the total return from the capital appreciation. The call premiums are going to be high, but you would actually get higher returns if you just invested into the NASDAQ 100, an ETF like QQQ, because the upside potential is not capped. So in a rising market, yes, you're going to participate in that growth, but it will be capped. And that's what we saw in that last chart with the performance. It trails the broader market in a pure bull market. Now, in a bear market or in a declining market, your performance is going to look a little bit different. With NUSI, you're going to have better performance than other covered call ETFs that do not have a collar option strategy in place because they're not implementing put options. So in a down market, you're going to have less downward risk with NUSI. And then lastly, in a flat market, your monthly premiums are going to be lower because call options and the premiums are all derived from market volatility. And when market volatility is low, you're not going to have as high of premiums. And so your distributions are going to be lower. So as we know, the market is volatile. You're going to have some months that are more volatile than others. It really just depends. But that's something that you have to be mindful of in a flat market. If you're going to invest in a NUSI, you have to understand the tax implications of investing into this ETF. There's really 4 ways that you could be taxed. It's based off of the net investment income, the short-term capital gains, the long-term capital gains, and the return of capital. The majority here in 2020, 2021 has been return of capital. That has been my understanding from the research that I have done. Return of capital is actually in my opinion, very advantageous if you never plan on selling your shares. Return of capital, all that does is it reduces your adjusted average price that you got of the investment. So if you never sell your shares, it's actually very advantageous as an investor. If you do end up selling your shares, it can be a little bit less favorable if you're in a taxable account because your adjusted price is going down. And so if you sell it for a gain, you're going to be paying a higher capital gains tax. But then it comes down to if it's short-term or long-term, depending on how long you've held the ETF. If you're like me and you're looking to grow your portfolio and live off the cash flow from your portfolio, it's important to understand how NUSI compares to other income-generating strategies. What I love about NUSI is you get the best of both worlds. You have the potential of the high income, the low volatility, the portfolio protection from the put option collar strategy. You have liquidity. You can sell the shares on the open market, but you don't have the risks, for example, with interest rates, inflation. It's not, heavily over leveraged. It really is a low risk investment when it comes to external factors. If you compare it to other investment options like REITs, MLPs, high yielding bonds, high dividend stocks, I really like to compare it to high dividend stocks. But what I like about it is you have less volatility. There's really not as much focus on the interest rate, and you don't have inflation risks, and also leverage, because leverage should actually be a check mark here because a lot of companies take on debt to fund their operations. And so this is something that I really like about NUSI is you have that high potential without a lot of the risks. So now let's talk about who should and should not invest into an ETF like NUSI. If you plan to live off the dividend in the next 5 years and you're looking for the current income today, this would be a great option for you. If you're risk averse and tend to get emotional during market corrections, this is a great option. Also, if you prioritize monthly dividend income, this is also a great option for you. And lastly, if you don't want to take on the risk of writing the calls yourself, you can invest into an ETF like NUSI that does it for you. So who should not consider investing into ETFs like NUSI? Well, if you plan to live off the dividend in over 5 years, I think you'd be better off investing into a higher yielding investment, something that is going to give you a higher return. Also, if you're in wealth accumulation stage of your life, you should really focus on investments that are going to yield a higher total return. And if you're an experienced investor, you could write your own call options and you could just bypass the expense ratio altogether, and you could do it without any fees. If you watched my last video on QYLD and JEPI, I shared my investing strategy of the core and satellite approach. My core holdings make up 80% of my portfolio. These are companies like Coca-Cola, Kimberly-Clark, PepsiCo, Johnson & Johnson. I also invest into my satellite positions that have a lower starting yield today, but are growing exponentially faster. These would be, for example, Waste Management and Costco. I don't invest into Bitcoin today, but I would consider it in the future. I would also consider investing into covered call ETFs like JEPI and QYLD, and in this case, NUSI. When I look at NUSI, I could see NUSI being a satellite position in my portfolio. It would be a large satellite position of around 5%. I really like NUSI because of what we talked about in this video, where you have the downward protection, but you also have the consistent monthly dividend income and a very high starting yield. Investing in a NUSI is something that I believe is a great way to round out your portfolio. I personally would not invest all of my money into NUSI or one of these other cover call ETFs because that's just not my investing strategy. But in my opinion, having NUSI in the portfolio to increase the weighted dividend yield and increase my monthly income, I think is, in my opinion, just a no-brainer. The only thing that gives me a little pause when it comes to NUSI is the high expense ratio. But I believe after the research that I've done, the high expense ratio, in my opinion, does not derail or deter me from investing into a cover call ETF like NUSI. Thank you so much everybody for watching. I hope that this video was helpful. I hope that you learned something new, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.